Disaster looms for digital currency group thanks to regulators and whales. This is the title of the article from Cointelegraph, which I have a link to in the description down below. I will be reading through this. I'll be giving my thoughts and opinions here at the end. And the shorthand version of this, guys, is that things are not looking good for this company, for Digital Currency Group. This is after the fallout of FTX and how it's rippled and affected lots of different companies, this being another one of those. Okay, let's go ahead and dive on into this. I am not a financial advisor. This is not financial advice. Everything I'm sharing is my own opinion. It's my own research. I highly encourage you guys to go do your own research. Regulators failed to regulate and venture capital firms invested without conducting the proper due diligence. The cryptocurrency tide is flowing out, and it looks more and more like Digital Currency Group, DCG, has been skinny dipping. But let's be clear, the current crypto contagion isn't a failure of crypto as a technology or long-term investment. DCG's problem is one of failure by regulators and gatekeepers. Since its 2013 inception, DCG's Grayscale Bitcoin Trust, or GBTC, the largest Bitcoin trust in the world, has offered investors the ability to earn a high rate of interest above 8% simply by purchasing cryptocurrency and lending it to or depositing it with DCG. In many ways, the company performed a major service to the crypto industry, making investments into crypto understandable and lucrative for beginners and retail investors. And during the crypto market's bull run, everything seemed fine, with users receiving market-leading interest payments. But when the market cycle changed, the problem at the other end of the investment funnel, the manner in which DCG leveraged user deposits, became more apparent. While not all questions have been answered, the general idea is that DCG entities loaned user deposits to third parties, such as Three Arrows Capital and FTX, and accepted unregistered cryptocurrencies as collateral. The dominoes fell quickly thereafter. Third parties went defunct, the crypto used as collateral became illiquid, and DCG was forced to make capital calls in excess of $1 billion, the same value of FTX's FTT token that DCG accepted to back FTX's loan. DCG is now seeking a credit facility to cover its debts, with the prospect of Chapter 11 bankruptcy looming if it fails. The venture capital firm apparently fell prey to one of the oldest investing pitfalls: leverage. It basically acted as a hedge fund without looking like it, loaning capital to companies without doing proper due diligence, and accepting, quote, hot cryptocurrencies as collateral. Users have been left holding an empty bag. In the non-crypto world, regulations are set up to prevent this exact problem. While not perfect, regulations mandate entire portfolios of financial documents, legal statements, and disclosures to make investments, from stock purchases and initial public offerings to crowdfunding. Some investments are either so technical or so risky that regulators have restricted them to investors who are registered. Adam here is pointing out over on Twitter. He says, what did I miss? Didn't we just say it was dimly $500 million days ago? Referencing from Unusual Whales, where Barry Silbert has reportedly revealed crypto firm has $2 billion in debt, per Wall Street Journal. But not in crypto. Companies like Celsius and FTX maintained basically zero accounting standards, using spreadsheets and WhatsApp to mismanage their corporate finances and mislead investors. Citing security concerns, Grayscale has even declined to open their books. Crypto leaders issuing "everything is fine" or "trust us" tweets isn't a system of accountability. Crypto needs to grow up. First, if custodial services want to accept crypto deposits, pay an interest rate, and make loans, they are acting as banks. Regulators should regulate these companies as banks, including issuing licenses, establishing capital requirements, mandating public financial audits, and everything else that other financial institutions are required to do. Second, venture capital firms need to perform proper due diligence on companies and cryptocurrencies. Institutions and retail investors alike, and even journalists, turn to venture capitalists as gatekeepers. They see investment flow as a sign of legitimacy. Venture capitalists have too much money and influence to fail to identify basic scams, con men, and Ponzi schemes. Luckily, cryptocurrency was created to eliminate these very problems. Individuals didn't trust Wall Street banks or the government to do right by them. Investors wanted to control their own finances. They wanted to eliminate expensive middlemen. They wanted direct, inexpensive peer-to-peer lending and borrowing. That's why, for the future of crypto, users should invest in DeFi products instead of centralized funds managed by others. These products give users control whereby they are able to maintain their funds locally. Not only does this eliminate bank runs, but it limits industry contagion threats. The blockchain is an open, transparent, and immutable technology. Instead of trusting talking heads, investors can see for themselves the liquidity of a company, what assets it has, and how they are allocated. DeFi also removes human middleman from the system. What's more, if entities want to over-leverage themselves, they can do so only under the strict rules of an automated smart contract. When a loan comes due, the contract automatically liquidates the user and prevents an entity from taking down an entire industry. Crypto critics will snipe that DCG's possible implosion is another failure of an unsustainable industry, but they ignore the fact that the problems of the traditional financial sector, from poor due diligence to over-leveraged investments, are the root causes of the challenges crypto faces today, not crypto itself. Some may also complain that DeFi is ultimately uncontrollable, but its open, transparent design is precisely why it is flexible enough to shake up the entire financial industry for the better. The tide may be flowing out, at least for now, but smart investments into decentralized finance today will mean we will be able to dive right back in when the next torrent comes, and this time with a bathing suit. So, all right, my final thoughts on this. Anyone that's getting involved with leverage trading, you are taking a significant risk. Lots of people get burned with leverage trading. The fact that major companies dealing with big bucks are so inclined to say, hey, you know what? Go big or go home, right? But when they're playing with people's money, everything is at stake. Their whole company, the reputations of the individuals that were involved with the company itself, not just even the company, but oh my gosh. And then all of the people's funds that they could have used for so many different things, all because it's being mismanaged by a caretaker here. These people, they're doing these gatekeepings and things. It's just absolutely insane. So things not looking great for Digital Currency Group. They are not currently at that stage where they have filed for Chapter 11 bankruptcy, as was mentioned here, but it's looking like it's going in that direction. Given the fact that we've seen FTX file for bankruptcy, I would not be surprised to see that this company also has a major issue. Grayscale, they did touch on that a little bit with them. I don't know if Grayscale is really going to step up and provide more transparent information. They're talking about things with security, but sure, you say those kinds of statements now, and then guess what? People decide that they don't want to be working with you anymore because they feel like they can't trust you. They don't know what you legitimately have, and this kind of sounds like you're trying to do a cop-out. A lot of people are looking at that from that point of view. Yes, it could legitimately be a security concern, and to some degree, I truly believe that it is a security concern. But people want to know that you actually have the assets. We need to have some sort of validation for this stuff, because otherwise this trust me bro stuff, like they're saying, yeah, just not going to cut it anymore. Let us know what you guys think about this down in the comments below. Thank you so much to my Patreon supporters. Double shout out thank you to WeLoveSafeMoon.com, Victor Vegas, SafeMoon Oz for being higher level patrons. Also thank you to my YouTube members for your support. And also guys, I do have a referral link to Webull down in the description below. You could get up to 12 free stocks. You could also trade cryptocurrencies on that platform. I've been using Webull for a while now. You can get more detailed information on that down in the description below. Again, I am not a financial advisor. This is not financial advice. Just sharing the option there for you. Thank you so much. We'll see you in the next episode.